Welcome to Strategic Wealth Builder, where we help you build a solid foundation for your financial future based upon providing you with a greater understanding of how many of the financial products and services you've been encouraged to use may not be doing the job you thought they were. Today we're going to talk about the major pitfalls of a 401k plan and an alternative that can provide you with better options to build wealth. The benefits of this alternative are less risk, more liquidity, and more control over your money. So here's the problem with 401k plans. 401k plans have become the standard for retirement savings in the United States. But there are several downsides to relying solely on a 401k for your retirement needs. One of the first problems is that your investment options are typically limited to the choices your employer's plan selects. This means that you may not have access to the best investment options or the ability to invest in alternative assets, like real estate, for example. Next would be market volatility. The stock market is notoriously volatile, and if you're invested heavily in mutual funds through your 401k, you could be at risk of losing a significant portion of your savings at any time if the market takes a downturn. Now think about that for a minute. You have no control over how your investments perform, and you are at risk for losses. We believe that there is a better way. In addition, there are some things in a 401k plan that most people don't really know a lot about, and that is the fees. 401k plans often come with high fees that eat away at your principal balance and reduce your growth potential. These fees can include administrative fees, management fees, and transaction costs. Then there are the withdrawal penalties. Remember, I mentioned liquidity, use, and control. If you need to withdraw money from your 401k before age 59 and a half, under the current tax law, you'll be hit with a 10% early withdrawal penalty, in addition to the taxes that are due on the money you withdraw. Now, after age 59 and a half, there is no longer a 10% early withdrawal penalty, but you will still have to pay income tax on that withdrawal. Now, a question you might ask yourself, are taxes in the future going to be higher or lower? Most people think they're probably going to be higher. So you might be withdrawing money from your 401k in a higher tax bracket than you deducted the contribution in. That will not work very well financially for you. If that's the case, you could be giving a lot of your 401k money to the government in the form of higher taxes. Well, what's the solution? We believe that a properly structured and funded whole life insurance policy addresses many of the pitfalls of a 401k. To start with, there is the guaranteed cash value growth and the protection from a declining market. Whole life insurance policies offer guaranteed cash value growth, which means that the value of your policy will grow over time no matter what happens in the stock market. And then there are the tax advantages of a whole life policy. Whole life insurance policies are tax advantage, which means that your money grows inside the policy, free from current taxation. And at any time, you can access the money in your policy through a policy loan or a withdrawal that is not subject to taxation. You can also create a retirement income stream that is free from tax if you structure your policy properly. We believe that most people are taught to focus on the accumulation years of a 401k plan, when the distribution years during retirement are significantly more critical. You can run into great financial trouble if you do not have an understanding of how typical market swings can wreak havoc on withdrawals during retirement. Unlike 401k plans, there are no penalties for accessing the money in your whole life policy because life insurance falls under tax laws that are much less restrictive. This means that if you need to access your money for unexpected expenses, you can do so without any penalty and not have to pay taxes on the withdrawal. Another advantage of using the whole life policy is legacy planning. In contrast to a 401k plan, which only leaves the cash in the account to the beneficiary and is actually taxable to the beneficiary, whole life insurance policies, though, combine death benefit with the cash value, neither of which is taxable. So as a result, the money you contribute to your whole life policy is producing multiple benefits for you. Tax-deferred growth, tax-free withdrawals, and a substantial tax-free death benefit for the important people in your life in the event of your death. Funding whole life policies is a strategy that the wealthy have used for decades to store large amounts of cash that is not subject to taxation, while at the same time leveraging those dollars in the form of a death benefit to pass on to the next generation a tax-free lump sum much greater than the cash value of the policy. This financial planning process by the wealthy gives the next generation a significant financial advantage during their lifetimes. So it's our suggestion that you should strongly consider implementing and utilizing the same strategy used by the wealthy. Because as you can see, while 401k plans may be touted as the standard for retirement savings, they don't provide everything you might need to be set up with financial certainty for your life. It is our belief that a properly structured whole life policy offers a better alternative, with guaranteed cash value growth, tax advantage withdrawals, and no penalties for early withdrawals, and legacy planning benefits, just to name a few. So at Strategic Wealth Builder, we are here to help you reach your financial goals, no matter how big or small they are. Contact us today to learn more about how a whole life policy can help you achieve your retirement goals.